Wednesday's post-Fed volatility spike and thus the accompanying drawdown in the stock market has lots of people now asking themselves whether the potential year-end rally from here on out still stands a chance or if it's really called off. I'd say two things about that. First of all, let's go to the charts and give you a perspective that the chart that we've been showing now for the past week and a half, I think it's been now. And we've said that historically, again, this just goes back 30 years of history. It's the white line on your screen. This is the seasonality of the S&P between October and the end of the year. And you can see we are still squarely within this sort of consolidation period. Now, obviously, markets were trading lower on Wednesday in the back of the Fed, and so that's still very much in the in the realm of this pullback. So should we be panicking here? No, I think there's never a time to panic. It's about being prepared, but also again, this still fits within the historical kind of norms, if you will, for December. Now, I will say one thing before we look at a couple of individual stocks. There is the precedence of 2018. And in 2018, the Fed actually did something quite similar in the sense that they kind of messed up the year-end rally by saying they're not going to cut rates, basically, and I'm not, not exactly word by word that, but that really the market didn't like. And so even though the market ended up rallying after Christmas, strongly into the year end, before Christmas it dropped 5, 6, 7%. I can't remember, like literally in a matter of days. So, there is precedence for this that's happened before. So that's, I would say panicking here is probably not the thing to do, but certainly it's a wake-up call, and that's really kind of what I'm trying to get to. I think next year is going to be the year of the trader. I've been saying this now for weeks on end. We really think that we are going to have a situation next year where lots of people that consider themselves to be self-directed traders but really are just chart chasing and buying dips blindly are going to get it handed to them, because markets are not that easy. As things become more dynamic, we need to be actually properly prepared. So just to give you a bit of an idea on this, when you look at some of these names that have now rallied very strongly, like an Apple and a Tesla, and we all know these names, these are the kind of names that in a normal market, we're normally functioning market, which I think we're going to have next year, more two-sided opportunities, should easily be able to check back, kind of retrace back to the previous breakout, maybe more. A lot of people are not prepared for that kind of thing. That from here in Apple is a 5-6% move. That's not a lot, but for a lot of people, that's the end of the world. For Tesla, a normal retracement move after Wednesday's move could still easily be 13 to 20%. Again, that's really normal. It's just a lot of people are not prepared for that kind of volatility because they're thinking of any down days, basically a buying opportunity, because that's worked for the past 15 years, obviously with exceptions. And so again, I just want to caution people to not get too complacent, because next year I think is truly going to be an unbelievably fruitful year for traders who are willing to look at the market open-minded and not just blindly buying the dip and hope for new all-time highs, because I really think that trade is over. And we're starting to see a little bit of this. So in many ways, I'm actually quite happy of what happened here on Wednesday post-Fed, because it is a reminder that markets can be very quick. And I tell you, there's a lot of people who are short volatility who probably blew up yesterday. It doesn't take much. I mean, the S&P dropped 3% in one day. I don't know the last time we saw a 3% drop in one day. You have to go back a long time. I'll do some math on this, but I think it's been quite a while. And so people just can't conceptualize that anymore. But quite frankly, this is not that abnormal in the grand scheme of things. We've just had an abnormal market now for 10 years, and I think we can have a normalization market here next year with a lot more two-sided opportunity. And that's the good thing. It's a lot of good news, a lot of good opportunity, I think, next year as we have a healthier market developing next year is really what we think, and a lot of opportunity. Hope it helps. See you again in the next video.